Have you ever wondered why your tax refund is so small? What if I told you most Canadians are overpaying taxes, but it's completely legal to avoid it? It's all about knowing the right strategies. Let's dive into the shocking truth about how the Canadian tax system works. Imagine this: you earn 70K and panic about being pushed into a higher tax bracket. Spoiler alert, the higher rates don't apply to your entire income. Think of tax brackets as mini piggy banks. The first bank gets taxed at 20, the next at 22, and the last at 28. So, on 70K, you spend around 15th of 400 on taxes after deductions. But wait, you're still getting some money back. Yes, that's your money. It's not free cash from the government. It's the result of withholding more than necessary from your paycheck. But if you have multiple jobs, guess what? You might end up owing money because your second employer doesn't know about your first job. What if I told you that you could turn 100K of salary into just 70K of taxable income by using the right strategies? First up are registered accounts. These magical tools can lower your taxable income, giving you a bigger refund. Let's talk about a group RRSP. This account is employer offered. By contributing, you lower your taxable income and snag a tax deduction. For example, if you make 100K and dump 10 into an RRSP, your income effectively drops to 90K. That's an extra 2,900 in your pocket. And the best part? Many employers match your contributions. It's free money. Just remember, withdrawing from an RRSP means adding to your taxable income, unless you meet certain exceptions like buying your first home or studying full-time. Next, let's explore the TFSA. It doesn't lower your taxable income but grows tax-free and withdraws anytime, no strings attached. The beauty of the TFSA is its flexibility. You can withdraw funds without penalties or tax repercussions. This makes it an excellent option for saving for short-term goals or emergencies, while still allowing your investments to grow. Now, let's discuss the perks of self-employment. If you do freelance work, you're considered self-employed, and this opens the door to tons of deductions. You can write off expenses like advertising, meals, office supplies, and even part of your home. For example, if you work from home and use a dedicated space, you can claim a portion of your utilities, internet, and rent or mortgage interest. This could mean significant tax savings. Imagine earning 100K but having 20K in business expenses. Your taxable income is now down to 80K. How cool is that? If you're a homeowner, you can also claim home office expenses, not just limited to self-employed folks. You could potentially save big on your taxes. It's essential to keep detailed records of all your expenses to substantiate your claims in case of an audit. Now, don't forget about childcare expenses. Families can get a deduction of up to $8,000 for kids under 7 or $5,000 for kids aged 7 to 16. These deductions can help alleviate the financial burden of raising a family, so be sure to claim them if you're eligible. If you're married, combine donations for max savings. Donations over $200 get you better tax credits. This means that if you and your spouse donate to charities, you might want to consolidate your contributions under one spouse to maximize the tax benefits. And speaking of strategy, how about splitting income to lower tax brackets? Consider a spousal RSP. The higher-earning spouse deposits into the lower earner's account, allowing for future withdrawals taxed at a lower rate. Genius! But be careful with spousal loans. Your higher-income spouse can loan money at a CRA-prescribed rate, helping lower taxes on investment income. Just be sure to report the annual interest. This strategy can be especially useful for couples where one partner earns significantly more than the other. Real estate offers great tax benefits too. Your principal residence is exempt from capital gains tax, which is huge. This means when you sell your home, you won't have to pay taxes on the profit you made. Some provinces even let you defer property taxes. Can you believe that? Rental properties, they generate income, but you can offset costs by claiming all rental-related expenses. For example, if you earn 30K in rent but have 20K in expenses, you only pay taxes on what's left. Plus, claiming depreciation can shield your taxes further, but tread carefully. There's a CCA recapture when selling a depreciated property. This means if you sell at a profit, you may need to pay tax on the depreciation you claimed while owning the property. Make smart decisions and plan ahead for tax season. So, what's the takeaway? Focus on your fundamentals. Don't make common mistakes that could cost you. Remember, knowledge is power. What strategies will you implement this tax season? Start by organizing your documents early, keeping track of all deductions, and consulting with a tax professional if needed. Also, consider investing in your financial education. The more you know about taxes, the more you can save. Attend workshops, read articles, or even take online courses focused on personal finance and tax strategies. Don't forget about tax credits for education expenses if you're pursuing studies or have kids in school. These can add up and reduce your tax bill significantly. Lastly, keep an eye on changes to tax laws. They can affect your financial situation and the strategies you might employ. Staying informed will help you make the most of your financial situation and maximize your refunds. In conclusion, tax season doesn't have to be a stressful time. With the right knowledge and strategies, you can navigate the system effectively and keep more of your hard-earned money in your pocket. Take action now and start planning for a more prosperous financial future.